Guys, we are always looking for opportunities in the stock market, and 52-week lows are a great place to start. When the company's beaten up, can you find opportunity there? It's no secret, this is exactly why we have an entire playlist dedicated to 52-week low stocks. So in this video, we're gonna look at 3 major companies sitting at 52-week lows, but we're gonna peel away the layers, look at the facts, and decide, is this an opportunity for the company right now? Is there a legitimate concern, or is it just the market being overly dramatic and beating up the stock, which is usually what happens? I'm your Uncle Paul. Let's take a look at the first company, a classic, Coca Cola classic, KO. Now guys, I personally consume 6 to 8 Coke Zeros or Diet Cokes per day. That is not an exaggeration. That is an absolute fact.
Yeah, it is.
If you are judging me right now, I don't care. I love that stuff. I'm addicted to it. I absolutely love Coke Zero.
How many do you drink at home? You drinking more on the road and in the office?
No, I do 3 to 4 at home.
Wow.
A day.
Damn.
I mean, I love it. I go to McDonald's every morning for a sausage burrito and a large Diet Coke light ice.
You switched it up.
Yeah, well, because the hash brown was getting a little boring. The sausage burrito I really love. It's a really good burrito. All right, so Coca Cola, a company that Warren Buffett's owned since 1987, $230 billion market cap if you wanted to buy every share outstanding. In the last year, they made $10.5 billion. In the last 5 years, they've averaged almost $9 billion. And look at their free cash flow. Last year, $9.5 billion. Last 5 years, $9.2. So pretty similar numbers there, right, Mo?
Yeah.
All right.
Have you been to the Coke factory in Atlanta?
No, I've not. Have you?
Yeah, it's pretty cool.
Was it?
Mm-hmm. Get the private tour, though.
There's a private tour?
Yeah.
Of course I'm going to do the private tour.
Yeah.
All right. Well, bottom line profit of the last 5 years is 23.2%. Last year, 23.8%. Very consistent. Gross profit of 59%. This means every extra dollar they sell, 59 cents goes to their pre-tax income, which is great. Okay. Dividend yield of 2.6% eats up about $6 billion of their $9 billion in free cash flow. That's a big chunk, but remember,
it's Coke.
Coke is a very low capital intensive business. They don't need a lot of cash to go reinvest back in the business in order to generate more and more revenue and profit. Okay? And 2, it's very, very in demand. So they can spit out a bunch of dividends, pay back their investors, et cetera. Look at this return on invested capital. 14.5%.
That's fantastic.
This means, guys, the market average is 9 to 10%. This means that they get a good return on the money that's invested in the business. And they don't need to invest a lot there to keep that profit up. That's what's awesome about Coke. It's a huge moat. Now look at this PE. Current PE of 22. Keep in mind, Warren Buffett paid a 30 PE back in 1987 when he started buying Coca-Cola stock. It was one of the first plays he did on buying a moat business. And he went and bought a huge chunk of Coca-Cola. And I did the calculation recently, including dividends. His growth has been about 11% per year, 11.5. So not a huge number, but for a guy with that much money to invest in it, it's very valuable for him.
It's pretty good return.
Yeah, it is pretty good return. All right, let's check out the 8 pillars on Coca-Cola. 4 checks, 4 X's. And remember, guys, if you have our community and our software, you can customize your pillars. But high on the 5-year PE, high on the 5-year price of free cash flow. Understandable, doesn't necessarily mean that Coke is overvalued. You should be willing to pay a premium for a company like Coca-Cola.
Absolutely.
Shares outstanding. I'm actually surprised by this. I would not have guessed that.
Totally surprised. They've been increasing them pretty consistently.
No, it's down from 10 years. It's down from 10 years.
Over the last 6 years, they've been increasing then.
Guys, I'm not going to lie to you. Don't care about the debt either. A lot of debt, okay. Coke's got a big brand. They ain't going anywhere. So this is the only question here. Is this too high a price to pay for the free cash flow and the earnings?
If it was me and I didn't really know anything, you just told me it was Coke, I would say, no, it's not too high to pay.
Let's check out the analyst estimates in the company.
Okay.
$272 per share in profit this year, $368 in 4 years. Revenue growing low to mid single digits. Understandable. Now, guys, before I'm going to pull up our stock analyzer tool. And the reason I'm going to do this, we're going to do this on the next 2 companies as well. But you guys have seen a lot in this community and this software, and there's a lot here to understand. So I'm not asking you to make a yes or no decision and give us money today. What I'm asking you to do is make an informed decision. And you cannot possibly make an informed decision on the outside. You got to be on the inside. You got to be in here using the community, using the software, engaging. Just like when you buy a car, you have to take it for a 15-minute test drive to get the feel for it. Do I like this car? Does it drive well? Does it have the things I like? That's what we're asking you to do here. Just asking you to come in here and take a 7-day free trial test drive, full access, nothing held off. All these tools, you can use all of these in our software, engage in the community, come in the general chat and say hi to me. Again, this free day, 7-day trial, I'm so confident you're gonna love this. They're gonna sign up at any point along the 7 days for a full year, but come take it for that free 7-day test drive at everythingmoney.com. Mo, when was the last time you did Coke stock? I don't even know if I've done it.
It was April, and I'm literally changing all my numbers. I don't know what I was thinking. I might have been playing.
Mine was February.
February?
And I did 20-year analysis.
Yeah, I might have been playing around or something.
All right. I mean, look at that consistent ROIC, Mo.
Yeah, it's awesome. There's so much consistency in there. I mean, look at the profit margin, the 5-year and the 1 year. I mean, it's awesome.
Yeah. All right. So what'd you do? So I did a 20-year analysis. Should I keep this 20? I might actually change it to 10 years because I've been doing 10 years a lot more lately. Mm-hmm. And guys, you can do 1 to 20 in our software. Mo, what'd you do for revenue growth?
I did 2, 3.5, and 5.
So you're probably right on that one. However, I think to myself, 3, 5, and 7 doesn't seem unreasonable to me.
7 seems high. I know they've done it. Close to doing it in the last year. But
if inflation's high, China gets bigger. The average person in China, this was years ago, was drinking 1 Coke a year, and the average person in the U.S. drinks like 1 Coke a day.
Really?
Something like that. It was some absurd stat like that.
Wow.
Now, profit margin. I think I was a little too conservative here.
I was too, and I moved it up.
I did 17, 19, and 21. Even though the last 5 years has been 23, yeah. I think I was being dumb here. I'm going to change this.
So I did 18, 21, and 24. And if somebody argued with me and said you need to go higher on the high end, I would be okay with it.
I'm taking my profit and free cash flow 20, 22, and 24.
Okay.
Because I look at this 10-year and how much it's jumped. I'm looking at it going, okay, this is probably pretty consistent. Same with free cash flow. I'm fine with this. Mm-hmm. Now, what PE are you signing to Coke for 10 years from now?
So I did 17, 20, and 23.
This one's a tough one. I did 16, 17 and a half, and 19.
Initially, I did 15, 17, and 19, and I was like, there's no way.
I'm just going to sign 20 across the board.
Okay.
Now, what's your desired annual return? Remember, guys, you can get 9 or 10% from investing in a long-term ETF. So you got to decide what's the right return for you for a company like Coke. I did 10, 11 and a half, and 13%. That's what I'm doing. I think that's actually wrong.
You think?
I think I should actually do 9, 11, and 13. Okay. Never forget. So guys, as you see, it just depends on where you are, things you think about. I'm looking at the February numbers going, why was I so conservative there? I don't know, but this is the art of investing. It shifts, okay? That's the thing. I look at this going, okay, but Coke is doing better. I look at these numbers going, why was I so conservative? So I'm gonna hit the analyze button here. And remember, guys, in the next 2 companies that we do this on, we're going to go a little bit faster through it. So if you want to understand more about why we did these things, just rewatch this part again. Hit the analyze button. I have a low price of 37, high price of 45, middle price of 41. Mo, what'd you get?
26 on the low, 42 on the high, 33 in the middle. My watch list price, I just moved it to $40.
I'm going to add it to my watch list at $47.50. So it's going to notify me everywhere on this one. All right, company number 2. Altria Group. We go from Coca Cola, soft drinks, to cigarettes. So this is a company with a huge dividend, 9% dividend yield. It eats up pretty much all of their cash flow, $6.7 billion of their $7.8 billion, but their free cash flow is up last year over the last 5 years, $8.6 billion versus $7.9. But look at this, Mo. Net income differences.
Yeah.
Free cash flow is so much higher than net income, so I love that.
Look at the market cap to enterprise value.
Okay, $75 billion. If you bought every share outstanding, enterprise value $115. That difference of $40 billion is essentially debt. Yeah. You think that's a lot, Mo?
I do.
Well, they can easily afford it according to their free cash flow numbers.
Yeah. Really good profit margin, gross profit margin. I mean,
well, their profit margin's up a lot in the last. Why is that?
I don't know.
They had that big write-off.
Oh,
they had the big write-off the 1 year,
Jewel or something.
Because look, big write-offs.
Okay.
Let's check out analyst estimates real quick. Actually, let's check out the pillars real quick.
How do you feel about the stock industry?
Listen, people are. This is going to be an unpopular comment. I don't care. It's they're not human trafficking. They're not.
Well, I'm not asking it from like a moral standpoint. I'm just asking it from like an ebb and flow standpoint of like health in the world and.
Well, I do think the world's getting healthier and healthier. With that said,
do you worry about the investment? I don't care about the.
Well, with that said, as the world develops more people are going to smoke for a while, and then it's going to decrease. Mm-hmm. It's only like 11% of this country even smokes anymore.
Yeah.
Well, cigarettes. But look at it, 8-pillar stock, Mo.
Yeah, I saw that.
Bought back 6% of shares.
Interesting.
Here's what's interesting to me. They're selling for 9 times free cash flow. Buy back your mother effing shares, guys. Let's see what the analyst estimates are. $5.15 a share in profit this year, going to $7 in 4 or 5 years. Revenue, very little growth.
Jeez.
Oh boy. Let's pull up the stock analyzer tool. When was the last time we did Altria?
I bet this is a while ago for me.
So these are assumptions I made in December of 2021. -2, 0%, and 2% revenue growth. I'm fine with that still.
Okay.
Look at these high ROICs that are increasing.
I know.
Okay, profit margin. Now here's the thing. 20, 23, and 26. Look at how wide-ranging these profit margins are. And free cash flow, I did 28, 30, and 32. Man.
So if the profit margins were wide-ranging, do you want to make yours a little bit wider?
Yeah, probably. So I'm going to change this to 22.5, 27.5, and 33.
Nice.
And free cash flow, I'm still fine with 28, 30, and 32.
Okay.
It's just weird.
Yeah.
Now look at this PE, Mo. The PE we had here, it's currently at 11 and price free cash flow of 9. I put 6, 9, and 12.
Okay.
Those are really low, guys.
Super low.
Well, why? Because I put a declining business here.
Right.
So I have to get my money back somehow. What'd you put in?
I'm just following yours right now. I have actually never run this through Stock Analyzer. Isn't that
Mo,
funny?
is 6 too low?
I think it is a little bit too low.
Okay, what should I put it at?
Maybe 9,
12.
12, and 15. Because I look at it saying, in the world of cigarettes and everything, Altria Group is
So I'm going to put 9, 11, and 13. Because I look at it going, it's still 2% revenue growth on the high side, which isn't a lot.
Yeah.
All right, guys, my desired annual return. I actually did 12.5% across the board.
Interesting.
But I'm going to change this now because we beat this thing up.
Yeah.
I'm going to go with 11.5, 13.5, and 15.5.
I like that.
Hit the analyze button.
What do you got?
20 to 24 on the low side, 33 on the high side, 25 to 30 in the middle.
Okay.
Now, remember, guys, these returns here, if you paid today's price, include dividends. So I'm going to add it to my watch list at $30.
All right.
Because I don't even want it. But at $30, I might sit there and say, okay, let me go to the community and start talking about it. Final company, guys, GIS, General Mills.
All right.
All-time high of $91 in May, currently at $63 per share. Wow. 5-year return on invested capital, 10%. Dividend of 3.5% that eats up $1.3 billion of their $2.4 billion in the last 5 years of free cash flow. Okay.
It's another one of those companies with kind of what do you do with the money?
Yeah, I mean, what's the growth coming from?
I mean, how many cereals can you make? Oh, they got Haagen-Dazs, though.
But look at this growth, Mo. 10 years ago, they did $17.6 billion in revenue. Now they do $20 billion. They did profit of 1.2. I mean, this is not a fast-growing business.
No, not at all.
Let's check out the 8 pillars. All right, 4 X's, 4 checks.
Okay.
Decrease in net income. Decrease in free cash flow, pretty much the same amount, which I like. Mm-hmm. Increase in shares, no idea why. I would have thought their PE and their price of free cash would be lower than that is right there. That's interesting. Yeah. Let's see what analysts are saying about the company.
I would assume it's going to be very slow growth.
Mid to high single-digit EPS, earnings per share growth.
Higher than I thought.
Low single digits on the revenue growth. Yeah. Boy. All right, let's go to Stock Analyzer tool. Have I ever done GIS?
I have not done that one either.
General Mills.
Interesting. All right, let's see.
August of 2022. You want to take a look at my assumptions, Mo?
Yeah, let's see what you did. Whoa.
1, 3, and 5%.
Okay.
11, 12, and 13 on the profit margin.
Okay.
12, 13, 14 on free cash flow since they tend to have higher free cash flow.
Right.
PE, I did 12, 14, and 16.
That's fine.
Even though it's General Mills, but I think it's like the slow growth is terrible. I actually did 15% across the board for desired return. I think back then I was doing, I'm going to sit here and I'm going to change this to
11, 13, 15.
That's a good idea. 11, 13, and 15%. I'm going to hit the analyze button. Boom. Low price, about $48 a share. High price of $55 to $60. Middle price of $45 to $50. It's getting close to that price. I'm actually going to put it on my watch list.
Watch list at like $53 or something?
Yeah, let's do that. $53 a share. Notify me. Guys, everythingmoney.com. Go check it out. It's free 7-day full access trial to our community and software. Thank you very much for your time.